Hello and welcome to week 3 of corporate finance. This week we're going to have the exam out there in a Word document. I'll have it out there Thursday morning most likely. It will be a window until Sunday at midnight to complete it. You are to complete it individually, and what you'll just do is you'll just give your letter response for each question. There may be some multiple choice and true false, but just respond accordingly, and I just ask that you put it in a separate Word document. Make sure your name is on that Word document, and just say like 1C, 2C, 3C, 25 true, etc. This week, if we look at Blackboard, also have your week 3 homework due. Again, good discussion last week on the time value money calculations. We look at chapters 7 and 8, a little bit lighter this week. And again, a reminder, after this week, we have the holiday break. So we'll have 2 weeks off. Enjoy the time off. I will be answering emails occasionally, but I do want you to take a break. So we'll start it back up after the holiday break. But some things I want to stress from the textbook in Chapter 7. Chapter 7, it's a brief chapter, but they talk about valuing stocks. They kind of initially talk about the difference between a primary market and the secondary market. The secondary market is what we hear about in the news all the time as prices change for stocks. One of the most important things I think that comes out of this chapter, if you look on page 197 of your textbook, they talk about the Gordon growth model, and sometimes called constant growth discount model. And to explain this, it's saying that we can say what the price of a stock is today based at there's a required rate of return for this stock, there's a certain growth for this stock, and the dividend 1 year from now. Say that a dividend is $3 today, and you expect to grow that dividend to grow at 5%. Well, you would take that $3 and multiply it by 1.05, and it would be $3.15 the next year. So they give a nice example there with the blue skies, saying valued at $75 based on the dividend 1 year from today is $3. The required rate of return is 12%. And the growth rate is 8%. Again, one of the things about this model, it's very basic in the assumption that dividends are constant. And the reality is that dividends are usually do not grow at a constant rate. Usually dividends, in that sense, rarely change. And sometimes it may even go down depending on the performance of the company. Another interesting thing they talk about is the difference between technical analysis and fundamental analysis. What we teach in this course is primarily fundamental analysis. We want you to go out and look at financial ratios, we look at the management, you make a decision whether this company is overvalued, undervalued. But technical analysis, that looks more at charts and plotting and trying to look at patterns and whether we should buy or sell the stock now. As you'll read more about efficient market hypothesis, learn more about that. The argument is that these things just don't hold true. In fact, I think I may put probably later in the course, I'll put a little snippet of a video out there about efficient market hypothesis and whether people act rationally with money or do they act irrationally. Okay, Chapter 8, we start to get into some valuations with projects, net present value, internal rate of return, payback period. Again, the idea ties in opportunity cost. What is appropriate rate of return for your investors? Later in the course, we'll look at how to actually determine that appropriate opportunity cost. But for now, it just tells you that the investor requires a 10% rate of return or an 8% rate of return. How did they come up with this rate? We'll talk about that in more detail later in the course. But with the net present value, essentially what you're doing is you're discounting back any future cash flows. See what the present value of those cash flows are. And again, remember from last week, as interest rates rise, the present value is going to drop. That is, as your opportunity cost rises, your present value of those cash flows is going to drop. It's going to make it harder to cover that investment if the rate of return is higher. Okay? Just the opposite, interest rate drops, present values go up. So the net present value discounts all those future cash flows back and then nets out or subtracts out the initial investment. As long as the net present value is positive, we'd say we would accept the project. It exceeds or meets the investor's opportunity cost. In fact, if it exactly meets the investor's opportunity cost, the net present value would be equal to 0. The internal rate of return is the other one looked at extensively in this chapter. And by definition, the internal rate of return sets the net present value equal to 0. So if we were kind of doing trial and error and say set up an Excel spreadsheet to discount cash flows and take out some initial investment and keep playing with it back and forth to find out what the interest rate that set the net present value equal to 0, well, that's what you'll learn to do in Excel in the other videos. So it can also be used as a hurdle rate, because if I require a 10% rate of return and the internal rate of return is 14%, I would accept the project. One of the downfalls, though, of the internal rate of return, if I'm looking at two exclusively mutually exclusive projects, maybe there's one project that gives me a high internal rate of return, but the other project gives me more cash and has a higher net present value. So bottom line, you'd always want to take the one that's going to add more to shareholder value. The payback approach is a pretty simple one. That just says that, I buy a warehouse, I spend $1 million 3 years, I recoup the cost of the warehouse, and it met that need, then I do the project. But that fails to take into consideration any opportunity cost. The last thing I want to point out on page 241, finding the difference between long and short-lived equipment, the equivalent annual cost. Just be heads up for, like, in week 5, I believe, you have to do a paper when you analyze, whether you want to buy this car, this washing machine, that dryer. But the nice thing with this, it allows us to make comparisons. Say one machine's only going to last 5 years, the other machine's going to last 15 years. Well, would you be better off buying a machine every 5 years, or just buy one that will last 15 years? So when doing equivalent annual cost, what they're doing there is they're discounting back all the present value of the cost, and then they're also including that present value of the cost up front. And once I find out what the present value of those costs are, then I can convert that to a payment. And that allows me to make a comparison to say explicitly what is the best option, what is the lower equivalent annual cost. Okay, well, that's it for this week. And one more thing, talk about the profitability index on page 245. So we would rank projects kind of by the highest bang for your buck, but look through and walk through the example there to make sure you understand that. But this is the last time I'll talk to you, probably on YouTube before the end of the holidays. So have a great Merry Christmas and Happy New Year's. And again, do email me if you have any questions, but take care.